Perfect. Thank you, Amy. Good afternoon, everyone, and welcome to this session. So today we're going to talk about the IFPR. We're going to go through a very quick kind of refresher of the key requirements and the kind of general aspects that have been introduced since January this year. We're going to focus on the ICARA, in particular the latest developments that we have kind of observed in industry, and also some feedback from the regulator as far as we've seen ourselves. And then I'll hand you to Osita, who is going to talk about regulatory reporting and remuneration, with some time at the end for addressing any questions you might have for us. So just to give a brief overview of IFPR in kind of very general terms, we assume that everybody is now fully aware of what the requirements are, what kind of the rules are all about. But I mean, as you know, a general, very high level kind of summary of what is applicable in the UK. So we had a split between the UK CRR, which remains applicable to the banking sector and only the large and systemic investment firms, and then the IFPR, which is specifically applicable to MiFID investment firms. So any firms that are authorized under MiFID or have MiFID permissions of any kind, including fund managers with a MiFID top-up, will be in scope. Also in scope will be regulated and unregulated entities that are subject to Prudential consolidation. So some of them will be only indirectly brought into the requirements. But we know now that all firms that used to be IFPR investment firms or BIPRA firms, as well as CPMIs, are in scope of IFPR. There's a new categorization that you have already certainly come across, which is small and non-interconnected for the smaller firms, and non-small, non-interconnected, which are the larger firms that meet or exceed at least one of the thresholds that have been set out to define the category. So the table below just shows the quantitative thresholds that are relatively kind of easy to test. And then you have what we call the kind of non-zero or permission-related type of thresholds, whereby if a firm is holding any amount of client money, or if they are dealing on account in any capacity, even if on a match principle basis, they will be regarded as non-SNI by default, which means that they will be subject to the IFPR rules in full without limitations. The key requirements that apply to the two categories, as we know, refer to three components for the non-SNI firms, which includes the permanent minimum, the fixed overhead requirement, and the K-factor capital requirement. So the K-factor requirement is unique to this category, of course, whereas SNI firms will only be subject to the permanent minimum and the fixed overhead requirement. Firms will need to hold the higher of the requirements that they calculate for themselves. And then they need to also ensure that they hold the sufficient quality of capital and a specific percentage of their requirement in the right quality of capital. So in the table below, you see that the amount of CET1 that a firm needs to hold has to be sufficient to cover at least 56% of the total own funds requirement. And then the subsequent levels, additional tier 1 and tier 2, will cover the remainder in different percentages. So the minimum amount of common equity tier 1, which is the highest quality, like paid up share capital or audited reserves, for instance, will need to be sufficient to cover at least 56% of the requirement. So the three components, as we said, include permanent minimum, which has the three levels. We just know that depending on the permissions the firm holds, the PMR will be different, of course. Important to notice that the £750,000 minimum requirement applies to firms that have permission to deal on account, including those that can do that on a match principle basis. So these firms potentially used to have a lower requirement under the CRR previously. Now they fall within kind of the highest level for the PMR. The fixed overhead requirement, which is the other component that is mandatory for all firms, is again, calculated on the basis of fixed expenditures from the previous year's audited financial statements. And it's important to note that this is meant to cover fixed overheads excluding any variable expenses as listed in the rules. So 2 points. So the first one is the exclusion of those variable costs is prescribed in the MiFID II rules and determines exactly which elements of your expenses can be excluded for the purpose of a calculation. But also there isn't a kind of a catch-all point that determines that any variable expenses can be excluded. So it is prescriptive. It gives a full list that is quite clear, and it's easy to identify those expenses that can be excluded, but there's no option to actually exclude any variable expenses by default if they're not included in this description. And then we have a K factor requirement, which is applicable to non-S&I firms only, and it's kind of the, of course, the novelty in the new framework, and it's kind of basically composed of 3 elements. So the risk to client, the risk to firm, and the risk to market groups. So K factors are basically in a firm's permission. There will be elements of kind of business activities that pose different risks, and the new regulation actually determines what risks are posed to different different subjects. So the key objective is to protect clients and to make sure that there is a requirement attached to the specific permissions, including, for instance, portfolio management for KUM or holding client money permissions for KCMH. For anyone who can deal on account, even if on a match principal basis, you will also have to apply the risk to market and the risk to firm K factors. These are specific to firms that have those permissions and are determined on the basis of, trading book exposures, but also to counterparty credit risk and kind of daily trading flow. So these components have specific formulas to calculate the K factor requirement. And of course, I'm sure most of you will have gone through the process already, because these were meant to be actually reported through your regulatory reporting requirements, but also they're required to be calculated for the sake of maintaining own funds that are sufficient at all times. So these are the 3 main components to the calculation of the own funds requirements. And like I said, this is only a refresher, so we're not going into the detail of each one. But then we know that there's also focus on liquidity. So the new framework has specific requirements on liquid assets, and there's a quite significant, but not necessarily too material requirement to hold at least 1/3 of the FOR in liquid assets. And this is to ensure that firms have availability of liquid resources to meet at least 1 month's overheads equivalent. This is the principle behind this, but the BLAR we will see in the ICARA becomes one of the key components of the base requirements for liquidity. The liquid assets that can be held to meet this requirement are defined as core liquid assets, and that includes mainly cash, UK gilts, or treasury bonds, but also to some extent trade receivables with a 50% haircut. For S&I firms, this is available in full, whereas it's only available to non-S&I firms who cannot deal on account if they intend to include this calculation. It's important to note that the resources that are held against the BLAR compliance cannot be used for running costs or ongoing operations. So that's an amount that needs to be segregated specifically for the purpose of meeting the BLAR. And then the new rules talk about prudential consolidation. So there's a specific set of rules that determine exactly how a group of entities needs to be treated and how it can assess the impact of the rules to the group companies. So a group is now defined as an investment firm group, and it's composed of any UK parent entity, which is defined, and any relevant subsidiaries and connected undertakings. This is where, of course, at least one firm in the group is a MiFID II investment firm and therefore attracts the MiFID II rules for consolidation purposes. Relevant institutions are the only ones that can be included in investment firm groups. So it's meant to be firms with specific business permissions or specific characteristics, including financial institutions, ancillary services undertakings, or tied agents. Credit institutions will generally be subject to the UK CRR, as we know, so they would potentially bring in kind of CRR consolidation if they are in the same group. But it can be, there can be instances where an investment firm group includes a credit institution when it is a connected undertaking. So generally when it is a third country bank that is included in the group. Connected undertakings is kind of the key new definition, and includes any firm that actually has some level of connection with the main firm of the parent undertaking. And this is driven by four general principles that you see on the slide underlined. So there can be majority common management, where the majority of both boards of the entities are actually shared. So if you have the majority of individuals sitting in both boards, there will be already a connection. Significant influence exists where the firm has the power to participate in financial and operating policies of the connected entity. And this is where potentially there is some, again, contribution to the financial policies or to kind of the business strategies of the other firm. Single management goes a little bit beyond that, because this means that between the entities there's effective coordination of financial and operating policies, which means that firms are actually being operated as if they were one single entity. And this is, of course, even more apparent when you have firms that actually share the same policies and procedures or the same board. And then there's connection by way of participation, where there's any direct or indirect ownership of 20% of the voting rights. This gives, of course, some elements of control across entities. Alternative to full consolidation, we have a group capital test, which, as we know, is an option for some firms if they have, of course, if they meet some eligibility conditions, of course, but which allows to reduce the test within the group to simply having a parent that holds sufficient own funds to cover the value of its holdings and investments in the subsidiaries or any contingent liabilities in the group. So it kind of reduces the element of capital adequacy in the group. Full consolidation means that all calculations need to be carried out on a consolidated basis. So that means that the group will need to be treated as if it were one single MiFID Pro investment firm, and consolidate the fixed overhead requirement calculations, the PMR requirements, and also the K-factor requirements if applicable. So if we jump to the ICARA, which is the focus of today's presentation, we know that this is a requirement. It's the internal capital adequacy and risk assessment, and it's basically a process that inherits quite a lot of the methodology that comes from the ICAP framework under the previous regime. But it now includes kind of new elements that are focusing on kind of the key components of IFPR, including, of course, the own funds requirements based on K factors, but also greater focus on liquidity and wind down planning, which are kind of essential to understanding kind of the financial adequacy within a firm. But the key concept is the overall financial adequacy rule, whereby the FCA prescribes that firms need to ensure that they can actually remain viable throughout the economic cycle and consider any harm that is posed to their activities at all times. But also a firm needs to be able to demonstrate that it can be wound down in an orderly manner. So these are the kind of the two overarching requirements for ensuring that the firm meets the OFAR. The ICARA still needs to be forward-looking, so it needs to be, of course, based on a point in time, which is what the FCA refers to as the reference date of the ICARA. But it needs to be forward-looking, because same as the old ICAP framework, you will need to actually build projections and build kind of risk assessment and stress testing, looking at what could happen in the next 12 to 36 months. Of course, the extent of the projection is relatively flexible, but it needs to be, of course, something that the firm can use and can be helpful for this, for the purpose of calculations. The two key requirements that apply within the OFAR are the own funds threshold requirement, which is, of course, based on capital, and the liquid assets threshold requirement, which is based on liquidity. So again, liquidity comes in as a key mandatory component. The The two thresholds will be calculated based on a specific process, which we will look at in a minute. But the important point is that these also depend on the risk assessment process. And again, risk management and kind of a risk management framework overall remains central to the ICARA. And therefore, firms need to ensure that they have a strong and solid risk management process for the identification and mitigation of any risk of harms. There must be an element of testing of the business model, recovery planning and wind-down planning that is based, of course, on the risks for the business. And then eventually firms need to assess the adequacy of the financial resources they hold against those risks. I specifically mentioned risk of harm because this is the new terminology and again, the elements of novelty in the ICARA. The risk assessment needs to be harm-led, and it needs to focus again on the risk to client, risk to market, and risk to firm groups that we mentioned earlier in respect of the key factors. This is meant to ensure that firms can assess what potential financial damage could be caused to their clients, of course, by any kind of trigger events, but also to the market and to the firm itself. The ICARA will still include elements that, like I said, were already in place in the ICAP, including stress testing and scenario analysis. The FCA says that firms need to consider instances of financial stress within the risk assessment, and also include reverse stress testing for kind of larger firms with more complex business structures. Firms need to consider recovery actions, so the ability of potentially remediating or preventing any potential breach of their own funds threshold requirement or liquid asset threshold requirement. And then they need to have a wind-down plan that is kind of fully documented and actually follows the guidance that the FCA has prescribed in the dedicated WDPG sourcebook, but also in the ICARA guidance in the MiFID II sourcebook. So the process for risk assessment follows, again, the standards that we have probably already been aware of for some time now. So risk management framework, again, is important for all purposes, but in this case, for the purpose of the ICARA itself, it is central. And therefore, the FCA focuses on kind of a governance and risk management policies and processes that are in place, the arrangements that are already established within a firm, ensuring that they are effective and proportionate to the business, but also having risk policies and allocation of responsibilities that are also fully documented and effective. One of the key components is always the risk appetite statement. I'm sure you've heard of this a number of times, and the FCA keep focusing on this. But the important thing is that risk appetite needs to be based on clear metrics and kind of measurable limits and tolerances that the firm can actually compare its risk exposures to. And this is a matter of, again, making sure that it's fully documented, but there's also a methodology that allows the firm to measure what kind of their strategy is aiming at in terms of risk exposures in each particular category. It has to be harm-led. I've already explained the point here, but just to kind of consider the steps that are meant to be taken for the purpose of risk assessment, firms will need to, of course, identify material risk of harm and categorize them as risk to client, to firm, and to market. So there is an element of recategorization potentially of the taxonomy you might already have on your risk register. You need to ensure that you assess liquidity risk. So any trigger events that could cause any kind of risk of harm to the liquidity position of the firm needs to be included. And this is helpful also to meet the threshold requirement on liquidity. Then the process follows the standard kind of step-by-step method, which is consider inherent impact, of course, consider any controls or mitigating actions that the firm can take, and then determine the residual impact to understand whether the firm should hold additional financial resources to cover residual risk of harm exposures. Firms that are subject to K factors, of course, will have the ability to also do a K factor risk mapping, whereby some of the K factors will already cover risk exposures based on, of course, the specific K factor we're referring to. So, for instance, KCMH refers to client money specifically, so risks posed by client money permissions will partially or totally be covered by the KCMH component, and this is what firms need to assess. Then potential mitigation. So firms need to consider what controls or what actions they can take to actually mitigate those risk exposures. And this includes, of course, systems and controls that can be stronger, but also implementing governance and oversight processes differently, or even make material changes to the business. So potentially, if any risk exposures cause potential harm that goes beyond the firm's appetite, of course, the firm will have the ability to kind of make sufficient changes to bring it back into kind of the appetite levels. And then finally, the add-on. This needs to be considered for both own funds, but also liquid asset purposes. So some risks may pose only an impact to cash balances or firm's cash flow. Some others might affect capital, and this is where the distinction must be clear when you determine the add-on further to the risk assessment. Stress testing, like I said, comes almost straight through from the ICARA framework. So again, severe but plausible assumptions need to be included. Consider all types of potential events that are kind of inherent to the business, but also come from the market externally. And also importantly, consider combined scenarios. The FCA keep focusing on this. So firms need to determine that a number of assumptions could potentially materialize at the same time, and you want to determine what the impact will be in those instances. Always determine kind of the financial impact of your stress scenarios, even if those kind of projections are eventually going to show a deficit at some point. That's exactly the purpose of stress testing. You want to determine what is your financial resilience point, where is kind of a break point where the firm will no longer be able to meet its requirements. And of course, reverse stress testing is a specific approach that firms should take. We usually advise kind of all firms to actually do reverse stress testing regardless, because it's a good exercise to identify the weaknesses or kind of the failing points by pushing assumptions to a point of failure. And this determines, again, the kind of limits of a firm's resilience. Recovery actions, as I mentioned earlier, are meant to kind of allow the firm to prevent or rectify a potential breach. And again, it could be for kind of cash or liquidity purposes as much as capital. But again, recovery solutions must be achievable and credible. So it has to be something that is potentially kind of accessible to the firm and is realistic. There must be an assessment of the actual amount of resources that could be made available through recovery, to bring the business back to financial viability. And also, of course, you must always identify any risks posed to those recovery actions that might kind of hamper the process. Wind-down planning, like I said, is a key component now. So it's coming into kind of the key requirements as well. But it's important to have an orderly wind-down plan fully documented. This has been the case previously, but the firm had basically insisted on this point and making sure that firms actually can demonstrate that they have sufficient resources to go through an orderly wind-down process. The structure is on the slide, but just a couple of points to focus on. The operational analysis, it cannot be just kind of an action plan that kind of confirms what will happen in the future. It has to be something that is, present and is actual, includes actions that are kind of realistic at the point in time where the plan is drafted. So it has to be operable. This is the key requirement that the FCA has kind of, mentioned a few times. It has to be something that can be, used, the following day for people to actually take step-by-step actions and make sure that the plan goes to completion. And then also important is the resource assessment. So of course, in here you want to have a cash flow analysis showing exactly what resources will be available and needed at the initial stages, as well as for the full completion of the wind-down process, but also ensuring that you can demonstrate your capital adequacy test. So the own funds threshold requirements and the liquid asset threshold requirements will continue to be, an element of testing up to the point where the firm will cancel its permissions with the FCA approval, of course. Communications is, of course, important to ensure that all the actions and all the steps are, communicated in a timely manner to the right individuals, counterparties, the regulator, etc. So all stakeholders will need to be informed at the appropriate time of the wind down process. So we mentioned the OFTR and LATR. So this is taken directly from the FCA's guidance on this, and it simply shows that you have two parallel assessments that need to be completed in order to get to the OFTR final kind of calculation. So you always need to determine what happens throughout your ongoing operations, determine kind of your own funds requirement through, of course, the K factor calculation, if applicable, and then determine, what risk exposures you have of potential harm to clients that firm into the market. This also needs to include, of course, the stress testing element that might bring, additional requirements. On the right-hand side, you will have an assessment based on wind-down planning, and this is where you will take your fixed overhead requirement and your wind-down costs and compare the two to take the larger of the two. This is total amount of wind-down cost, and this is a requirement that actually, again, highlights the importance of wind-down planning in the process. Eventually, the firm will need to hold the higher of the assessment A result and the assessment B result, and then always compare these with the PMR, which in most cases will be kind of the lower value and therefore not necessarily relevant. Important to say that the own funds threshold requirement can never be lower than the fixed overhead requirement. So again, through the comparison process in the two assessments, you should never come to a point where the own funds threshold requirement is smaller than the FOR. And this is why this is also defined as the own funds wind down trigger. So FOR is also the minimum limit whereby the firm will come into a wind down mode if you were to hold own funds lower than FOR. The process, of course, includes, as we said, looking at K factor, fixed overheads, and permanent minimums. So these come from your own fund requirement calculations. You will have these components already available because this is kind of formula driven, and therefore you need to calculate these. And these are also the ones that you will be reporting through your MIF returns. But then you will have the component that is driven by the risk assessment and kind of the wind down plan calculations. So the additional own funds requirement that will be compared with these comes from the part of the assessment. Similar process, and again, the diagram explains that you have two parallel assessments, is true for liquidity. So the liquid asset threshold requirement, again, goes through the assessment of liquidity risk through ongoing operations, understanding the amount of assets needed to fund the ongoing business, but also consider risk of harm and also liquidity stress testing in the process. Whereas on the right-hand side, you will still have calculations based on your wind down costs. In this case, wind down costs will only need to be considered for the purpose of the amount of any additional liquid assets needed to commence wind down. So only covering the initial stages of wind down, not the full cost of wind down to completion. And this is because, as you see in the box at the bottom, the rule says, first of all, you will always need to hold the basic liquid asset requirement amount, which is 1/3 of your FOR. That's always going to be the minimum you hold. And in addition to that, anything that comes out of the two assessments, taking the larger of the two. So again, this is going to be presented as per the next slide as being BLAR as a minimum, plus any additional liquid asset requirement coming from either the risk assessment or the wind down analysis. Again, same as with the OFTR, there is a wind down trigger, and that is that firms can never hold cash or liquid assets in a smaller amount than the BLAR itself. One point in the box at the bottom, which is quite important actually for the purpose of the ICARA itself, is that liquidity needs to be presented in a quarterly breakdown in the ICARA. So this is helpful for the purpose of ongoing reporting, but also the ICARA itself, as an annual process, will need to show a quarterly breakdown, identifying the kind of the spikes of liquidity requirements in each quarter. And this is to allow firms to potentially hold the right amount of liquid assets in the appropriate period when those kind of higher cash flows are going to be incurred. This means that firms will not necessarily need to hold the maximum amount of liquid assets at all times. They will just need to make sure that they can meet the quarterly requirements as and when this actually happens. Monitoring triggers are kind of the supervisory points that firms need to consider when they actually look through the kind of the ICARA position. So the ICARA will be helpful to determine what the requirements are, of course, but then these triggers are kind of the thresholds that firms need to keep an eye on to ensure that the ongoing monitoring allows them to satisfy the basic requirements. So there's an early warning indicator that is referring to own funds only, which basically says firms need to make sure that they hold at least 110% of their OFTR at all times. When the value goes below this point, then there must be some communication with the FCA or determine whether any recovery actions need to be actually implemented. Then you have the standard threshold requirement breach, which means that when the firm comes to a point of breaching the own funds threshold requirement or the liquid asset threshold requirement, there will be, of course, a notification to the FCA, and that might trigger a full recovery plan to determine whether the firm can rectify the position, but potentially the FCA could intervene and determine what the firm should do next in order to rectify the breach itself. Of course, the worst case scenario is the wind down point, and this is the wind down trigger that we mentioned earlier. So OFTR going below the fixed overhead requirement, or LATR going below the BLAR. At this point, the notification to the FCA is mandatory, of course, and it's the point where the firm will need to commence a wind down process. And the FCA will, of course, agree to reduce the permissions up to the point of cancellation throughout the process. The SREP, so supervisory review and evaluation process, is still in place, and the FCA still maintains the same powers as they had under the ICAP. But again, it's now being kind of tweaked slightly in the way that the FCA can actually intervene and kind of impose any new obligations or further restrictions to the firm. And this might affect the percentage of own funds requirements, but also impose a governance scalar, which could be a fixed percentage applicable across the board, or potentially recalibrate the K factor component. So the FCA could determine that the firm has a greater exposure driven by portfolio management that could potentially impose a greater KAUM to the firm. And then it could be in the form of a fixed add-on, so same as a capital planning buffer in the past. Of course, there will be recommendations given by the FCA if they find, of course, any kind of weaknesses in the firm's ICARA, but then the action they could take is, of course, potentially quite severe, because it could remove permissions or even adopt, higher wind down trigger, which actually brings kind of the wind down point to a higher level, and the firm might actually incur into this at an earlier stage than it was originally planned, or before meeting kind of a BLAR point. So the first round of ICARA reviews that we are aware of has already been communicated to all firms with an ICG, or at least those firms that the FCA wanted to actually review in the first instance. And if you haven't heard from the FCA yet, then potentially for at least this first round, the FCA will have kind of already done their own reviews. We've seen some FCA communications with firms, and they are focusing on the key aspects that we mentioned earlier. So again, risk management, of course, but K factor calculations, LATR, and wind down planning are key points to consider. And this is actually kind of coming into the FCA's expectations that we are aware of. So again, key points to remember, of course, as we said, governance and risk management framework, essential to anything a firm does, of course, but also to be fully documented within the ICARA or be referred to in the ICARA, so that it's kind of clearly linked to the process. ICARA needs to be proportionate to the business, of course, so there will be simpler or more complex ICARAs out there, but it needs to give a true representation of the firm's position, its risk assessment, the stress testing exercise, the wind down planning, and then ultimately a fair calculation of the OFTR and LATR. Important to say that the use test concept remains, so the FCA still expects firms to use the ICARA or its kind of constituent parts on a daily basis. Firms need to comply with requirements at all times, and firms need to ensure that they meet liabilities as they fall due at all times. So anything that is actually included in the ICARA will need to be tested on an ongoing basis. You will have the MF007 return, that is the kind of ICARA questionnaire to be submitted by firms, and Osita will talk about this in a moment. Also importantly, the ICARA is meant to be on a solo basis, even if a firm is within a group, unless of course the FCA has decided to have a group ICARA or a consolidated ICARA. So in the first instance, all firms will do ICARA on a solo basis. Same thing applies with the wind down plan. Wind down plan is meant to be on a solo basis and include consideration of potential kind of group interactions or kind of group failure as one of the scenarios to be included. And then finally, again, just to give basic references, the MiFID Pro Sourcebook is of course the main place where firms will find the rules, but also the FCA refers back to FG 20/1, which gives guidance on kind of the ICARA process and risk assessment, but also by Pro 12, which has now been removed from the handbook, but the FCA have said if firms have used this in the past to build kind of a liquidity risk management framework, they can still refer to that in the new ICARA. So this ends this first part, and I will look at your questions to address at the end, but I will hand you to Osita for the next part.
Thank you, Giovanni. Good afternoon again, everybody, and thank you for joining us today. My name is Osita. I'm an associate director in our financial services advisory practice, and I lead our unit that looks at our retained book of clients for ongoing support. And what I thought we'll cover, or what we wanted to cover over the next 12, 15 minutes or so, is a high-level canter through the regulatory reporting requirements for firms under IFPR, and highlight some of the issues or banana skins we've seen in some of the reviews we've done when looking at firms' submissions. And then we'll also touch on remuneration very briefly at the end. So next slide, please. With 2 cycles of reporting now done, I think most firms will be familiar with the new reporting framework. They are nice and simple quarterly and annual returns, which we will look at in the next slide. And the purpose of the returns haven't changed. They are supervisory tools that the FCA uses to not just monitor prudential adequacy, but all other data points in businesses that they will be interested in. All returns, or most returns, apply to all firms, including SNIs. Some apply only to non-SNIs. And the returns cover the similar sort of things that firms would have reported on under the old regime. So, for example, the P&L, the balance sheet, the capital adequacy, etc. There are the new returns as applicable to K factors, so the MIF 003 and the GCT, but otherwise, the other reports are fairly familiar to firms. Next slide, please. So what we've tried to show on this slide is the transition from the old world to the new world. So in the old world, firms generally had to report either FSA 001 or 002, depending on whether, 001 or 029 for balance sheet and 002 or 030 for the income statement. It's all been harmonized now into what I would say are fairly less sophisticated templates, but they are the templates that have been chosen by the FCA. And those report on balance sheet and the income statement, and the guidance continues to remain applicable. The guidance that existed for 029 pre-IFPR remains applicable post-IFPR. And they take some getting used to, and because they are less fields or less clear-cut fields, In some cases, firms will have to choose a box. So for example, sundry debtors or other debtors, and stick to it, simply because there isn't much further guidance on those templates. The previous capital adequacy return, which buy-proof firms filed, if-proof firms did co-reps, there's now one common template, the MIF 001 for capital adequacy. Thankfully, the frequencies have not changed for these returns. The Pillar 2, which is we filed annually, remains the same in the new world, where we now file in MIF 007, which Giovanni spoke about earlier, and that's annual as well. And some firms will be getting ready to prepare or submit those filings now, depending on the submission dates that were communicated to the FCA. Some firms have been able to move those dates forward because of their own schedules and constraints. But I know for many of our firms, some firms are reporting over the next quarter or so. The high earners return has been replaced with the remuneration return 008, and the CPMIs, their returns have been simplified to refer to just the 067 now. And then the entirely new ones are the 002, 003, 4, 5, and 6, which, depending on whether the firm is a group or not, and whether it's an SNI or not, might not need to file some of those returns. So for example, only IFGs with who either applied prior to the transition date of 1st of February to notify that they were going to use the GCT, or have now received confirmation from the FCA that they're using the GCT, would be in scope of 006. And then 005 is specifically for non-SNIs who have dealing on own account. Next slide, please. So as Giovanni pointed out, the obligation under the IFPR, what they've called the OFA, the overall financial adequacy rule, applied from the 1st of Jan. And what that required, or what the rule says, is that firms should hold adequate financial resources to be able to meet their obligations as they fall due. Now, that refers to the OFTR and the LATR. Now, as we covered in the previous section, OFTR and LATR is the output of the ICARA. So there was a bit of initial confusion in the industry as to how to manage the apparent disconnect between submitting my ICARA much later in the year or even in 2023, whereas the OFAR applied from 1st of Jan 2022. And it's what it does is that it brings the importance of doing the ICARA and getting the ICARA right. It makes it even more important because there is a bit of a grace period, a bit of a transition period, where firms will, understandably, where the FCA will take the view that firms need to bed in the new requirements. And so OFARs and how well firms have computed OFTRs and LATRs will not have been considered or pressed upon to date. But we can expect, our expectation is that in the coming year, as more firms complete the ICARAs and the FCA have more 007 returns, then they would start to test, the data will start to show if firms have applied the rules correctly, and if they have undertaken a robust enough assessment. So as we said earlier, the IFPR applied from 1st of Jan 2022, which is when the OFAR requirements applied as well. And if firms have estimated additional capital requirements or own funds or liquidity requirements arising from the ICARA process, then that will feed into the ICARA and into subsequently the 007 as well. And so the message really is, if for firms who have maybe pushed this far ahead, there's always one regulatory, there's always a regulatory hoop to jump over. I guess the key message and what we're hearing from the FCA is, please, even if the 007 date is much later, please factor this into your project planning to ensure that you get it right in time before whatever your submission date deadline is. And also ensure that at least the directors understand it as well, because when we work with firms or when we support the FCA on Section 166 reviews, one of the things that they're usually keen to understand is the level of rigor that the board has subjected the ICARA document to. And so it's quite important that the board minutes evidence that challenge. It should be evidenced in minutes that, you know, the board has challenged the assumptions for forward forecasts, for risk scenarios, for the management actions that will be made, whatever key assumptions are being made in the ICARA. It's important that the minutes reflect the challenge. Otherwise, it appears that the board hasn't robustly looked at the document. Next slide, please. So just a couple of quick initial observations. I think that there was a teething period, if I could use that term, where firms, as they got to grips with the new requirements, there were some initial errors that we've spotted on some of the returns we've looked at. So in some cases, the understanding of the guidance in MiFID Pru 9 was misunderstood. So, for example, the usual suspects are, for example, the field for annual relevant expenditure, where some firms maybe put in the FOR, or fields for the AUM, where firms had filled in the KAUM. So there were those initial first-time challenges, you know, that came through from the initial set of returns we've looked at. Consolidated reporting has been another area where we've seen lots of misunderstanding, and that generally comes in either in the calculation of the own funds or the own funds requirements. The guidance is clearer in some bits than others, and so those were areas where we've seen some issues, particularly in own funds calculations, where the deductions may not have been applied as appropriate. One classic, often missed deduction is qualifying holdings outside of the financial sector, because in MiFID Pru 3, unhelpfully, it does not, qualifying holdings outside the financial services sector is not one of the deductions. So firms had prepared templates based on 336, but had not considered qualifying holdings outside of the financial sector. So if there are investments on the balance sheet outside of the financial sector, then it's worth bearing in mind that those need to be subject to the deductions according to the rules further down in MiFID Pru 3. Other challenges we encountered have been reg data. A lot of firms spent a lot of time working with the FCA to get their schedules correct. 006 was a classic return where there were issues, for example, when parent entities did not have FRNs, and so firms had to create or liaise with the FCA to allow reg data, allow them submit it, and where transition provisions were reported when actual numbers should have been reported. So I think the key message from us is really the governance of the reporting process, ensuring that that 4I check is in place and that all parties within the team understand the guidance, and if necessary, liaise with advisors or specialists to make sure that they have interpreted the rules correctly. Because the FCA is keen to ensure that firms report correctly. Moving on to remuneration. So as you know, most people on the call will know, there's a new remuneration code. So gone are the BIPRU and IFPRU codes. There is now the MiFID Pru code embedded in CISC 19G. And the core principles haven't changed, which is good. The core principles remain effective risk management, alignment of risk and reward, supporting positive behavior, discouraging harmful behavior. The rules will apply for performance periods beginning 1st of Jan 2022. That will mean then that for firms with 31st of December year ends, 2022 will be the first performance, will be the first such period. And so we can expect your remuneration payouts, for example, in variable pay, to take effect early next year if bonuses are to be paid, etc. Next slide, please. So at a high level, under the new remuneration code, there is the basic requirements which applies to all firms, the standard requirements that apply to non-SNIs only, and then the extended requirements that apply to the largest non-SNIs. And the largest non-SNIs are those that have on-balance sheet assets and off-balance sheet items, either greater than £300 million or just over 100 million, but they have trading books of greater than 150 million or derivative businesses greater than 100 million, based on notional, based on the value of their trading book. And so if firms fall into that category, then they are in scope of the extended requirements. The remuneration rules apply on a firm basis as per this slide, but they also apply on an individual basis as will be seen on the next slide. So on the next slide, you have the basic requirements which apply to all staff, the standard requirements which apply to material risk takers only, and the extended requirements which apply to only those material risk takers whose variable remuneration exceeds particular thresholds, the threshold being £167,000 for variable pay. So if an individual earns variable pay, annual variable pay, that is under £167,000, and that pay does not make up greater than 1/3 of their total, then the extended requirements will not apply to them. Similar provisions existed in the IFPR code, and so that requirement has largely been carried forward into MiFID-Pro. Next slide, please. So material risk takers, they used to be known as remuneration code staff, but the concept is the same, i.e. they are individuals who will have a material impact on the risk profile of the firm. The FCA have issued particular guidance, specific guidance as to what that means and how firms should be interpreting, should be identifying who their material risk takers are. I guess the headline message on this is really that it is possible, as many firms are finding out, that the material risk taker population may be different from the population that existed under either BIPRU or IFPRU. And so it's important that firms spend some time looking at the delta between what the BIPRU requirements or what the old criteria were for identifying MRTs and what the new criteria are, and ensuring that any new people come in, that process is properly managed and early engagement is factored into the project plan for ensuring successful implementation. Next slide, please. Because we're running short of time, I will not go over all the requirements in a lot of detail. For many firms, all firms will be in scope of the basic requirements. The standard requirements, as we said earlier, will apply to all non-SNIs. And the point I just wanted to highlight with the standard requirements is really the ex-ante and ex-post risk adjustments. We see this a lot on the asset management side of things, where some of those firms may already also be in scope of the UCITS or the AIFM code. A lot of AIFM codes and UCITS codes also have similar provisions. But what the FCA have said, or what the rules say, is that where there is a conflict between either the AIFM code and the MiFID-Pro code, then the more stringent requirements should be applied. And so when it comes to ex-ante and ex-post adjustments, all of that needs to be taken into account. So for ex-ante, before award, ex-post, post-award, deferral, retention provisions, etc. Moving on to reporting. Next slide, please. Reporting will commence at 4 months from the accounting reference dates. So for firms with 31st of December year ends, their first reporting will be at the end of April of 23. For 31st of March year ends, that will apply 4 months after what would that be? July 2023. So there's some time to plan and get it right. The new MIF 008 return has a bit more detail requested than what we had under Rep 005. And so firms should generally have a look through it and make sure that the data is in place to enable successful or accurate reporting. Public disclosures is all firms will have obligations on their public disclosures for remuneration, and this will include SNIs. For firms that are have year ends this year, their old money Pillar 3 disclosures will have their transition provisions that apply, and we can, if any firms have any question on those transition provisions and how they can apply them, then we'll be more than happy to take those questions separately. The initial observations that we have, next slide please, from working with firms who are looking to embed the new remuneration requirements in their programs is really the delta, identifying that delta, or what really is different from what was applied before and what will be applied now. Fixing the pay ratios. So under the basic requirement, firms are required to make a distinction between the fixed and the variable remuneration they pay. And the standard requirement requires that there's a ratio fixed between four categories of staff. Now, benchmarking against what's happening in the industry is a good thing to do. However, where firms, for example, have remuneration committees, or if not the board, in considering those ratios, it's important, just like with the ICARA, that assumptions and the rationale for it is discussed and evidenced within the minutes. Where there are changes to the MRT population, then that has knock-on impacts on SMCR, because the MRT definition is now linked to the conduct rule certification definition as well. So where there are changes, then from an SMCR point of view, documentations need to be updated as well. TORs might need to be reviewed for REMCOs or for boards, as the case may be. If deferral periods are longer than 3 years, then they need to be explained. They have to be at least 3 years. And really, the headline is early stakeholder engagement, because where remuneration goes badly, it's down to either how the process was managed with the individuals whose pay might be impacted positively or negatively as a result of these rules. That is it from me. I know we have just a couple of minutes. I don't know if there are any questions for Giovanni or I. Yeah. Otherwise, we can take questions separately, I guess. Yeah.
Osita, yeah, I'm going to address some of the questions that came through the Q&A window. Thank you for submitting those. So just looking at some that we can address fairly quickly, and then we'll make an effort to actually provide something in writing after the session as well. So one question about fixed overhead requirement. Are the fixed overheads based on latest financial audit, financial statements? Yes. So what is called the relevant financial expenditure is fixed overheads as per the latest audited accounts. Wind down plan for firms with more than 20 employees, and thinking about redundancies and how these could affect wind down costs. Of course, this needs to be considered as an additional cost that might come up in the wind down process, but also needs to be considered for the purpose of a resource assessment, understanding who will remain essential to the firm to actually complete the wind down steps, and therefore ensuring that those members of senior management or staff that are essential to the process are actually either in place or are employed for the purpose of that. There's a question about calculating the add-on capital based on a risk assessment. Normally, a risk assessment will include a scorecard of some kind, or or a risk matrix that determines a quantification of the impacts. So financial impact is always quantified as a monetary amount, of course, which is a potential loss or a potential additional cost that the firm might incur. And therefore, there should be a process whereby a risk matrix determines what a specific impact in terms of score translates to in terms of capital or cash add-on based on the ICARA process. There's a question about reverse stress testing. Does it apply to all firms? Technically, no. So the FCA have said reverse stress testing really is for larger and more complex businesses only. Like I said earlier, I think we generally advise firms to consider reverse stress testing because that is potentially the place where you will find the right assumptions ahead of kind of the wind down kind of trigger. So this is a process that kind of follows from the stress testing exercise that applies to all firms anyway, but it's potentially helpful for smaller firms, not only for larger firms. And then finally, there was a question about KDTF. Does it apply to firms that do not deal on account? That's a very good point, because originally this K factor was linked only to firms that deal on account. The FCA guidance actually applies KDTF also to those firms that execute orders on behalf of clients in their own name. So if firms are executing orders in the firm's own name, they will have a KDTF component that they need to calculate as well. This was not clearly kind of apparent from the original rules, but then the FCA specified that this is applicable. I think this covers the key questions that I've kind of managed to address. There were a couple on remuneration. I don't know, Osita, if you want to spend a minute to.
One question that has come in is around if the remuneration requirements are likely to change with the changes in the announced changes to bankers' bonuses. Nothing we've heard so far on that. We expect that if the caps firms may have set the cap at 50 or 100% of fixed pay prior to the announcement. If they are increasing it, then again it just needs to be justified and evidenced as to why that is appropriate and how that doesn't impact on the risk management objectives that the firm will have under the remuneration rules. But we don't expect a change in the rules, at least nothing that has come through from the FCA yet. Yeah.
Perfect, thank you. So I think we are a couple of minutes over, but thank you so much everyone for joining the session. Hope it was helpful. Of course, there was a lot to take in, but we'll try and address those other questions you've submitted in writing. Amy, any closing points?
Hi, yep, thank you all. Thank you for that session. Yep, as you just mentioned, Giovanni, we will circulate the recording and try to respond to all of the questions as well. But yep, that's all from me. Thank you for attending today.
Thank you, everyone.